Traders, so what makes a good trading strategy? That's the question we're going to answer today on episode 15 of the Independent Quant podcast. I'm the host and founder of the Independent Quant, Luis. I'm not a financial advisor. I'm a trader just like you. I make no guarantees of success or profitability. So with that, let's just jump right into what makes a successful trading strategy, right? And one of the characteristics of a sound strategy is positive expectancy. When I started trading in 2016, I signed up for trading education. One of our instructors made this comment that's stuck with me since, which was, amateurs care about win percentage, professionals care about expectancy. Expectancy didn't mean a whole lot to me at that time, but over the years I've come to really appreciate and understand what he was trying to communicate with that statement. And expectancy is how your strategy performs over a series of trades. So it's calculated by taking your average win, multiplying it by your average win size, dollar size, multiplying it by your average win percentage, and subtracting from that your average loser size, multiplied also by your loss percentage, gives you expectancy. And that number we want to be as high as possible, definitely positive. We don't want a negative number, which means that in essence, if we looked at that formula, that the product of your winners and your win percentage is less than the product of your losers and your lose percentage. So you're losing a lot more than what you're winning. Now, expectancy, like I said, you want it to be, if it's positive, then your strategy has an edge. The next question now becomes of how high should it be? Well, now that question's a little harder to answer, and like with all statistics, you want to have a baseline, right? You want to understand what are you comparing this to. If your strategy is something that you didn't come up with yourself, maybe you can look up the strategy that you're working with, be that a trend following strategy, a mean reversion strategy, and see how your expectancy compares to expectancy for those strategies. Now, expectancy is, even in those scenarios, because we each trade in our own way and we have our own risk management parameters, expectancy can be a little hard to come up with a hard, decisive number as far as like what looks good. But what that you can do with that, though, is that's not the end of it, right? It doesn't mean that there's no value in this exercise. If we start off with just the understanding that it needs to be positive, cannot be zero, cannot be negative, then we say, okay, we've got a positive strategy. How can I make the expectancy increase? And now you have a framework to start working on how you're optimizing your strategy, not just for win percentage, but for expectancy, right? Because your win percentage can actually go down and your expectancy go up, because that means, again, going back to that formula, maybe your average winners are now that much larger and your average losers are that much smaller, which means that regardless if you're winning less, you're winning much bigger winners. So expectancy, that can now be your exercise, is you've determined that, yes, you have a positive expectancy. How do I increase the value of my expectancy? So that's number one. Number two is your risk reward optimization. That, again, all these statistics they're tied to one another, right? You tug on one, it's going to affect the other. Risk reward now, like I said, you can have a lower win percentage, but if your risk reward now is that much higher, you have much more survivability with your strategy. So you want to make sure that you're looking at increasing your risk reward or placing it within a range that's acceptable. An example here is I do a lot of trend following strategies. And depending on, I focus a lot on ES, which is the S&P futures. In that scenario, I know that a 10-point run in ES is a fairly good run. 20 is an exceptional run. If it goes up or down 20 points, that's an exceptional run, especially when I'm looking at 1 to 5 minute data. If if I'm looking at a much larger time frame, then that move isn't as significant because it probably looks like chop. But in a 1 to 5 minute chart, that is a visible move, right? So if I am setting up my risk rewards inappropriately, where I'm trying to capture a 30-point move, I'm going to get stopped out a lot. At the same time, if I'm trying to capture a 5-point move, I'm going to win a lot, but my risk to reward may not compensate me for my losers, right? So you need to find a spot where you're looking at your risk to rewards by either by shifting around your targets. Your stops are usually pretty fixed, right? You know how much you're willing to lose per trade, either by a dollar amount or by a percentage of your account, but you have that freedom with your when you're going to get out of the trade as far as profitability goes. And like I said, you can work with that one so that you can increase your risk to reward. If your risk to reward is 1-to-1, you need to be winning over half the time in order to be profitable. That starts shifting significantly to the point where if you've got a 3-to-1, you can be around 27%. If you've got a 5-to-1, it goes into the teens, and that's your break even, right? That's as low as you can go with those. So it gives you, if your strategy is, you're winning a healthy percentage of time, given the type of strategy is, let's say we're going with a trend following strategy, you're winning at 40%, which is within expectations for that type of strategy, and you're consistently hitting 3-to-1, you're doing great, right? But now if you're looking at your profit factor and it's at 2 and you're at 40%, see if you can get a little bit more out of the market, is where I'm going with that. So that's something that the risk reward optimization, one of those characteristics that makes or breaks a trading strategy. Next is adaptability to market conditions. Adaptability can mean a lot of things, so I'm going to have to narrow down what adaptability means. And let's use, again, a trend following strategy as our guide. A trend following strategy really only works in trending markets, right? So if there's no trend in the symbol that you're using, it just won't work. The drawback to it, the danger of a trend following strategy is when a market is going sideways, meaning that it doesn't have a trend and it's just oscillating up and down around some price area or some price range. In that scenario, if you haven't coded your strategy appropriately or you're just going off of every signal that it's kicking out, you can chop yourself to death, right? It'll annihilate your strategy. So what adaptability means in this sense is that it's able to decipher to some level of risk management, right? It's not going to be perfect, but that it can decipher, hey, this is the danger of where the strategy doesn't work. So it's able to adapt and filter out those components. Trading, if it's a trend following strategy, it's not trading in a choppy market. If it's a mean reversion strategy, it's not trading in a trending strategy, right? So it's able to adapt to whatever the market conditions are. Now, if you want to get even more advanced and say, take that one step forward of not just staying out of the market when it should, but maybe now you blend two different types of strategies together where you're saying, if it is a choppy market and it is oscillating, maybe I can trade the tops and bottoms of that range. Maybe I can include some type of mean reversion so that if it's not a trending market, it does this other strategy within this same body of code. I shy away from that. What I'd rather do is have two different strategies on a symbol. This way it adapts that way, but doing it all within one strategy is viable, and it is a way to provide your strategy with that adaptability. Now, the next characteristic of what makes a good trading strategy is that it's backward and forward tested. And what does that mean? So backtesting is, again, I hammer this to death in all my episodes here, but it is looking at a period in history where you feel that the market conditions were similar to the ones that you're about to put your strategy into, and testing out your rules to see how they would have performed in that market. Gives you a statistical report. You're able to assess whether or not it's a sound strategy, both in profitability and in risk management. But the other side of that coin is you want to also be able to forward test your strategy. Divide your data up in such a way that your strategy is trained on one portion and then tested on another. The benefit you get out of that is now you're testing your strategy on data that it was not trained on, right? That is eventually how your strategy is going to work, right? It's going to go into the live market, trading data that it's never seen before because it's live market data. It's never been processed before. It needs to be able to function in those. So that wraps up the 4 big characteristics of a sound trading strategy is that it has a positive expectancy, has good risk to reward, that it's been optimized for itself, it's adaptable to market conditions, and that it's been both backward and forward tested. So given that, what makes a good one, then what makes a bad one? How do we fail as traders when we're doing our strategies? The first one, which is one that I drive home a lot in a lot of my podcasts here, is overfitting to historical data. Curve fitting is one of the worst things you can do. It usually happens when we just continue to optimize, continue to update our parameters to the point where your strategy is now really good at performing under the market conditions that you trained it on, but it hasn't generalized the data, the strategy enough so that when new data comes in, those same rules and those same parameters apply in those market conditions, right? So the one thing we want to watch for is just catch yourself of how often have you updated the strategy that you're working on. If you've really gone through this a lot and gone through so many iterations of the same strategy, same logic, and just keep toying with the parameters, and it keeps getting better and better and better as far as your profitability and all the good things we like to look at as traders, it's time to take a step back and consider that maybe you're overfitting that data or overfitting that model to that data. That's a big one. The next reason why traders fail on this is ignoring market regime changes. I hinted at this in a successful one, which is adaptability. Well, this is the other side of that, which is now you want to make sure that you're paying attention to what the market is doing and any shifts that it has. Now that includes going from a ranging market to a breakout to a trending market. We would just want to know that, again, where our strategy works and where it doesn't, and keep track of the market and make sure that if it shifts, you're making the proper decisions to either re-optimize your strategy or stop your strategy or put on a new strategy. But you cannot ignore market changes because strategies don't work in all markets. The third one, as for why traders fail, is poor risk management. I've said this, you can have a winning strategy, but with bad risk management, you can blow up an account. You want to make sure that you're adhering to sound risk management practices. One of these is risking no more than either a percentage of your account, definitely no more than 2%. Usually the rule of thumb is 1%. If you trade 1% of risk no more than 1% of your account, it will change. The actual dollar side changes with your growth or loss of your account. So it keeps things nice and simple. Knowing that no more than 1% of my account is going to be risked per trade. There's another part of this, which is you want to make sure that you are not trading correlated symbols, because let's say you're trading the S&P 500 and the NASDAQ, those two pretty much move together. They're two sides of the same coin. They may move one more than the other or faster than the other. NQ is known for, NASDAQ is known for being a very fast moving symbol, but typically it's in step with the S&P 500, right? It's usually an order of magnitude. But all this means for risk management is if you were to put a trade in the S&P 500 where you're going long, and you put another trade in the NASDAQ also going long at the same time, and you limited yourself to 1% of your account, in reality, you've now you're risking 2% of your account. Because if you lose in one of those, you're probably going to lose in the other one because of the correlation between the two. Now, we can argue, yes, of course, if you win in one, you win in the other, potentially. But that's not how we think as professional traders. We think in risk management. We don't put money on the line unless we have some level of assurance that, yes, this is going to go our way. It adheres to the rules that we've developed, and we're not putting ourselves in a position where we're opening the door for a risk of ruin. So poor risk management, one of the big reasons that traders fail. The next one is unrealistic execution assumptions. So if you have a strategy that, let's say you have a fairly decent size account, and you can take quite a bit of risk on that account. You can take a large position size, and you're trading something like a currency futures, as an example. You are now choosing that you're going to be able to trade this phenomenal strategy where you're going to take 300 contracts at a time. Well, hey, you're the thing that you're trading may not be liquid enough to be able to absorb your position size without it affecting and moving the market, right? So now you're going to be getting fills that are not consistent with what you expected, but they're actually consistent and real for the market, right? So one is that position sizing may not be up to par for or within your belief system, right? You have to take slippage into account. So that's a big one there is how does the market actually work and does your strategy work within that? And the last one, it kind of goes without saying, but it is just simply a lack of discipline. In order to be a successful trader, you have to be able to stick the course, right? It took me 2 to 3 years before the time I went live with real money. I went with a smaller account size. With that, it takes time, right? And it takes time to develop the skills. It takes time to do the things that you have to do and all these other elements of that makes a successful trader other than just following rules. It takes psychology. We're athletes, we're financial athletes, if anything, right? So the way you get good is simply just showing up, following a structured path, sticking to that path, right? One of the things that I did wrong myself when I went from simulation to a live trader was I was a little cocky and thought, hey, I can do more than one strategy. I hadn't tested those strategies. I hadn't practiced those strategies for 2 years. I had only practiced this one strategy for 2 years. And I had a losing month. But when I looked at my statistics, I had a winning month had I only done the strategy that I had been training on for the last 2 years. So that's the big thing is you want to be disciplined, disciplined in following your rules, disciplined in practicing your craft, disciplined in understanding and getting better at reading statistical reports, and that's statistical reports for your trading strategy, but also reports coming from the from the economy if that's part of your trading strategy. Discipline. We absolutely need it as traders because we don't want to be affected by greed and fear, which is what we're trying to capitalize on. We're trying to capitalize on other people's greed and fear. We don't want to fall victim to it ourselves. So now we talked on what makes a successful one, what makes a winning trade and what makes a losing trade strategy. How do we actually apply this knowledge? So I'm going to give you now 5 steps on how to develop a profitable strategy. The first one is starting with a data-driven edge, right? We want to have a disciplined, rule-based way that generates profits, and that rules need to be based on data that we've collected and tested, right? So be that if you're employing a mean reversion strategy, a momentum strategy, arbitrage, if you're that advanced, you can't be successful at any of those strategies without taking a data-driven approach. Step 2 is once you've chosen your that you're going to go ahead and be a data-driven trader, now you're going to need to develop your strategy. And developing that strategy, one of the things you want to make sure that you are able to identify are very clear entry and exit rules. One of the things that being an algorithmic trader allows you to do is once you backtest a strategy, many of these trading platforms allow you to place the entry and exits for all the positions that it took on a chart. And that's a good visual way for you to go through and just visually examine how clear the strategy was entering and exiting trades, right? Was it following the rules? Did the rules actually make sense, right? Your entries and exits shouldn't be so convoluted and dependent on so many things that you can't inspect and verify that your strategy is working. Some of you may trade with black boxes. That's your prerogative. You need to be able to inspect your entries and your exit. And the only way you can do that is if they're simple and clear and identifiable. So now we enter step 3, which is now backtesting and validating that strategy. And what that looks like now is your trading platform is going to allow you to select a period of time. You're going to backtest it. You're going to see how it performs over time. And once you develop this, you haven't curve fitted, you haven't over optimized, now you can validate that. If you've done everything up to this point, you can still now see, is it following the rules, because you got visual indications and you can immediately assess if your entries and exits are correct. The next one is implement real world trading expectations, considerations into your backtest, which is part of what we've talked about and what makes a strategy fail, which is not accounting for costs and slippage, right? Most trading platforms allow you to do this is select putting in commissions or trading costs into your trading strategy so that it calculates those in each one of the transactions that it does, each one of the trades, and that'll factor into your profitability or losses. Not doing so is very detrimental. Additionally, you want to be able to include slippage into your trading strategy. You want to make sure that your strategy is tested with that by including, hey, you know what level of slop do you want it to introduce, both good and bad for your fills in that sim strategy so that you have a more realistic assessment of how well this strategy is going to perform when it goes live. So that's step 4. Step 5, monitor, optimize, and adapt, right? Our strategies will not work forever. You have to keep on top of them. You have to, even after your backtest, when we're in the validation stage, you're taking simulation data, you're going to live data, but simulated trades. You want to see how it's actually performing and compare that to what you expected out of the backtest. If there's differences, try to figure out why there's differences. Maybe it needs to be re-optimized. If that's the case, then do that. See if there maybe was something wrong with the logic or how your platform processed backtest data compared to live market data. That's the time to kind of assess that. If you're now trading a live market, live account with real money, this is definitely where you want to make sure that you are comparing your current performance to your backtest performance. And the last bit of that is adapt, right? And the strategy is not going to work forever. So make sure that you have rules in place to identify when you're going to take that strategy out of the market, when you've decided that it's no longer worthwhile to optimize it anymore, and or it's time maybe to tweak it so much that it's version 2.0 or version 3.0. But you need to be able to adapt. Don't get married to any one strategy. No, you follow that 5-step process there, you're well on your way to have a profitable strategy. And that is, a lot of what a lot of people just simply don't do, right? They don't go through this process of everything that I just described. But if you're one of those people that you definitely do want to go through the process, then navigate on over to the Independent Quant, download our free resource on how to get started with quantitative trading. We have courses available for you that if you're interested in taking a much more deeper dive into that. If that's your case, I'd love to see you in the community. I look forward to seeing you next time on our next episode. Again, this is Luis. Keep it green. Out.